I have 500 rupees and I want oranges and apples. Sir, for rupees 500, you can have an assorted fruit basket of a bit of every fruit.
That's exactly what an exchange-traded fund does. It gives you access to the whole basket when you choose an ETF. Aim to enjoy the fruits of your investment. Invest in ETF. Smart option choose karo. ETF karo. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hi, everybody. Thanks very much for tuning in. You're watching our series of webinars on ETFs called Decoding the World on ETFs, brought to you by Mirai Asset Management. And today we're going to be discussing a very interesting topic. In fact, a very, very hot topic these days, which is global investing. And the route that we're discussing is through passive funds. So joining me today, I have Siddharth Srivastava of ETF products at Mirai Asset Management, and Gurmeet Chadha, co-founder and CEO of Complete Circle Consultants. Gentlemen, thank you very much for joining us and to talk about this very, very exciting topics, because we know the many virtues of, say, ETFs or any kind of passive products, right? But with a specific intent to invest in global markets, is this the right way to channel your investments? What is the advice that you give to clients?
I think global investing is definitely deserves an allocation in the client portfolio. It can vary from 10 to 15% depending upon the size, the risk appetite you have, and also your financial goals. A lot of investors may have some goals relating to buying overseas assets or sending children abroad. I think this active passive debate, in my view, is overstretched, and I think it's more about marrying or blending the different styles rather than one better than the other. For unfamiliar terrains, and if you're entering for the first time and if your knowledge is limited, obviously passive makes more sense. So, and if you remember in 2015, Morgan Stanley came up with a active passive framework, which said that each market presents unique opportunities. Each asset class presents each opportunity. So it's more how you blend it. So if you want to play the larger market, let's say I want to invest in US markets or China market, passive is better, as points raised out by Siddharth. But if you're an evolved customer and you have some ideas where you want to play niche themes, which are not efficient, let's say you want to, play the tech theme, and you might find the weightages being, too high for few tech names. In that case, you can play either an active or a passive beta style.
Okay, so it is not just enough to blindly go and buy the first passive fund that you see. You have to see what exactly you're aiming for and where it fits in your portfolio. And so that this question of where it fits in your portfolio is what I want to ask you is, let's assume we're talking to new retail investors. Because the more savvy ones would have already figured it out, right? So if we talk about new investors who are just sort of getting in and all, what should this passive portfolio of global investing look like? I mean, I assume that the mother market, you say the US, there are plenty funds, right? So you bung in some allocation to that. I mean, does it need to be complemented by something else?
So obviously, first of all, as in case with any other investment product, the investment objective of the fund and the profile of the investor should align. And post that, like Gurmeet has mentioned, that probably investor can start with, let's say, 5% allocation and then increase it to 10 or 15%. The initial allocation for less savvy investors probably can be based on simple, plain vanilla passive product or active products, let's say, on the passive side, something based on NASDAQ or S&P 500. And then that should be the core allocation. And probably as a satellite or as a tactical allocation, what investors are very keen right now is taking exposure into emerging technologies or disruptive technologies. And probably he or she can add those funds which are providing exposure to these companies which are into emerging tech space as a satellite portfolio. So there are a lot of possible combinations which we can do with global products, but anyone should start with probably a lower allocation and then gradually increase it to 10-15%.
Okay, I see that both of you have used technology as an example. So let me build on that a little bit, because anybody who's investing in a global market I would expect that they also have a sizable domestic allocation, right? And you take the next step to move on to global markets. Now, if we take on this exposure to, say, tech or even pharma for that matter these days, Gurmeet, do you need to also tie that in with the domestic allocation that somebody may have for tech or pharma? Because, even if a person just has, say, a diversified equity fund, right, they would also be overweight on tech or pharma. So are these two separate markets, and therefore does, say, for example, the domestic tech exposure and the, global tech exposure, are they separate entities altogether, or does it at some point tie in with your overall portfolio?
I think it's a brilliant question. I think the underlying is extremely important, as you pointed out. My view is less the overlap, the better. So that time, there'll be times where the market in general will do well. The entire tech space will do well, or we saw the entire pharma pack doing well, right? It doesn't matter whether you were in API space, or you are making the vaccine, or you are in diagnostics. But there are some themes which are not represented in India. So, for example, EVs, we have very limited plays. Gaming, we just had one. Nazara Tech coming, social media, OTT platforms, renewable energy. There are a lot of sectors which are either not represented or underrepresented in India. And I think that is where offshore helps you fill the gap. So, mind you, our market cap is about $3 trillion. The G8 economies, which is, I would say largely, if I were to say a developed world, has a lot of new emerging themes where the representation is low. And I think, and passive helps you, offshore helps you fill that gap. And overlap as much should be avoided.
Siddhant, the other thing that I wanted to check with you is that, while on the face of it, most ETFs would be at par, right? When you compare costs, etc., transparency. It's just that, the flavor they bring or the exposure that they have differs, right? But within ETFs of, similar exposure or similar categories, how big of a difference does tracking error make? And for an investor, what should he understand about, what is tracking error, and does it impact their returns?
So that's a great question, and like you have mentioned that ETFs may have different investment objective, and that is the first and foremost important thing which investors should take note of before investing. Let's say the investment objective is same, and then what we look at, the tracking error becomes very important, especially in case of global funds, because there the AMC needs to take care of a lot of issues, including time zone difference and forex movement, etc., to ensure that the investor is getting the returns which is similar to the returns of what the underlying index is giving, right? That's why investor has invested into the concerned passive fund, and that is why tracking error, tracking difference is important. Between, let's say, within Nifty 50 ETFs, if you're talking about Indian market, the difference will be very low. But what that will illustrate is that how well an AMC is managing the passive product, and what are the hypothetical chances that the management of the ETF can go wrong and you might realize a return which is different from the index. And tracking error and difference basically is a very good barometer to judge how well the ETF is being managed by the AMC.
Gurmeet, if you've been reading that S&P's PIVA report, they've been highlighting for a while now about how the active funds have been underperforming the benchmarks, right? And side by side, we have seen, if I just pick up the inflow numbers for the month gone by, equities have seen 9,000 crores of net inflows, which is equally matched by the passive basket, right? So ETF, fund of funds, the whole thing combined. Is this whole passive funds now gaining traction over active funds? And if you look at this whole sphere of global investing, what is the portion of the pie? And what are investors actively coming to you and saying that, we want global exposure through passives, or is it you having to convince them?
It's actually both. I think the advisors should also play equal emphasis on it. I think you're right. I think the percentage of funds beating the benchmark have been shrinking, and it is not a 1 year, 2 year phenomena. We are seeing that trend. So what we are seeing is more in large caps. I think the alpha generation has been difficult to go by. So I said, when you have to play the broader market, I think passive, and I think passive will continue to gain market share. I have no doubt about it. In fact, when BlackRock did this in 2009, when they bought Barclays Global and iShares, there was a lot of uproar that how can a fund house have both strategies, right? And Larry Fink made a point that we have to coexist, and even some of the other greats, including Warren Buffett, they've been finding difficult to beat S&P 500, right? So I think this is a trend which is here to stay, and but in a lot of categories which are not efficient, where let's say liquidity could be a constraint. Let's say, for example, small and mid cap category domestically, right? Huge variation between the top performing fund and the benchmark and the underperforming funds. Also, some of the niche themes overseas as well. So I think it's about marrying it. Larger trends, efficient market. I think passives are gaining traction, but niche themes, small and mid caps, etc. I think so. So you have to just blend it, right? More evolved the customer, active could be higher. More passive, more long term, more lazy investing. I think you have a higher share of passive investing.
Siddharth, the other thing which is all the rage these days is the smart beta products, right? Now, I understand that, just by changing a few factors here and there, you can optimize your returns compared to maybe plain vanilla products. Is that a suitable option when we're talking about global investing?
So, globally, as you mentioned, smart betas have been a rage. They have now an AUM of more than $1 trillion, which is great. But in India, there are smart beta products, even on the passive side, and it is yet to take off because I think investors are still trying to understand how it works and how it behaves. See, before investing in any smart beta product, you need to understand the factor first, in which cycle it performs, in which cycle it doesn't. An investor needs to be aware about that and take an informed call because a low volatility based smart beta ETF will work very differently than, let's say, a growth based ETF or a momentum based ETF in different cycles. And that is what investors should be aware about when he's investing and when he's thinking of redeeming. In India, I think right now ETFs, while it has taken up a lot of scope, is still left. So people will probably lap up to plain vanilla ETF first, and then move on to thematic and sectoral products. For example, even on the global investing side, people will prefer to invest in, let's say, a EV theme based product, a semiconductor based product, or a e-commerce or social media based product, rather than moving on to smart beta this soon. The development will happen, but I think probably the time is too soon to think about smart beta on a global investing level.
But Gurmeet, one more thing. There is some misconception, perhaps in investors' minds that, global exposure is only for HNIs, or the fact that, passive products is only for a very evolved kind of investor. Is there any truth to this? And what has been the experience with non-HNIs?
No. I think it's a very good point you have raised. I think it's completely a myth that offshore investing is only for HNIs. I think if you see the offshore names, even for retail investors, the products and services we use of household names are so prevalent. OTT is not for HNIs. Social media is more for the general masses now. So I think it's a myth. And earlier there were issues. We had limited options, right? LRS had its own compliance issues, the reporting through banks, 250,000 USD limits, and that limits kept changing, with the frequent issues with foreign exchange reserves. I think now we have more vehicles, we have plain vanilla options, retail products. I think FOFs, which allow you to do SIPs, even in these global offshore passive strategies, I think it's a great tool. I think an SIP in S&P 500 or Nasdaq or some of the other things for a period of time should be a core allocation over the long run.
Siddharth, what would you say to statements from investors saying that, if I invest in a passive product, I will only get the market return. I will not be able to generate alpha. Is that really true?
I think Gurmeet mentioned one point that people focus too much on that, and probably asset allocation is something which is also very important to create wealth, right? And you achieve that asset allocation through passive funds also. One thing which investors, and we actually get that question a lot, that this fund and a passive fund will not ever generate alpha. But the point is that the mutual funds, the active mutual funds in which you invest, they can generate alpha. But the question is, how many of them are generating alpha? And when you ask that question, and how many of them are generating alpha on a consistent basis? I think if we look at large cap category, we looked at last 5 calendar years, and there was not even a single large cap fund which was in quartile one in each of those 5 calendar years. So point is that okay, passive fund cannot generate alpha, but active mutual funds, uh, can it generate alpha, and how consistently it has generated alpha. So that is the probably answer which we give to investors, and I think there is more than enough data to talk about why passive funds merit a look even by the retail investors, especially in categories like large cap funds.
Fair enough. Gurmeet, one more question, and perhaps I should have asked it a little higher up. But do you need to assess your risk profile, before investing in passive products, and secondly, also before investing in global markets?
Absolutely. I think all the more, because your understanding, it's an unfamiliar terrain. The way you track domestic markets, it's not easy to track global markets. So the risk level has to be assessed properly, and one should avoid any momentum-based or tactical calls, thinking that, for example, okay, the pharma will do well. Let me pick up a pharma ETF which has mRNA names who are making, let's say, vaccines, right? You can easily get carried away in bull markets, getting into something which is, as you made a point, it's a rage, right, among players to look at smart beta strategies. So extremely important. Make it goal driven, right? Do not link it to some movements or some themes which by gut you think are going to do well, right? Make it goal driven. See the historical correlation that particular theme has with your portfolio over a long period of time, and be prepared. So there will be periods, and it is exactly meant so that at all some point of time some portfolio does well. So different asset classes, different geographies do well in different periods of time, and that's the beauty about asset allocation.
Yeah, so some part of your portfolio will always be performing, right? So that just one final question to you. You know, we've been talking about the evolution of passive products also, but at some level, a lot of skeptics still feel that the whole passive investing itself might be a bit of a fad. Is it here to stay, and is it going to become a proper challenger to active funds in the years to come?
So, while passive investing in India has taken up now, in US it started in early 1990s, and it is growing strongly since last 3 decades. Right, its AUM is now north of $8 trillion right now, and if you look at inflows, the passive strategy actually overtook the AUM of equity active mutual funds in US. I think a year back or so. So I think as markets become more efficient, I think large cap in a way has probably, if it spills down to even mid cap, let's say you'll find more and more categories which will be become more suitable for passive funds, like probably large cap has become. And we are already talking about people investing in thematic space using ETF as a route. Because let's say if you want to take exposure, and we talked about it earlier, into EVs, into let's say social media, into battery technology, etc. Probably you want to do it based on a rule-based, transparent methodology, and not through an active fund, because how many expertise you can have on so many interesting themes which are emerging, and people at times prefer to use these simple low cost medium to take very focused exposure in emerging themes. One of the, and actually thematic ETFs have taken quite well in last 1 year in global ETF market.
Yeah, the tactical allocation, right? All right, Siddharth, Gurmeet, thank you very, very much for joining in to explain this concept to all of our investors. Thank you very much for your time and thank you for your insights. So, everybody
Pleasure.
who's watching, I hope you found this useful. And if you have any further questions and comments, do feel free to reach out to us. We'll try and have them answered as well. Thank you very much for watching.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.